Stop. You are being lied to. The economy you're seeing on the news, it's a mirage. The job numbers they're celebrating, fabricated. The housing market they claim is stable, well, it's built on quicksand. I'm about to show you the economic truth they don't want you to see. In the next 20 minutes, I'll reveal why the Magnificent Seven stocks are creating a dangerous illusion, how millions of jobs literally disappeared from official reports, and why the biggest foreclosure crisis in a decade is being kept under wraps. If what I'm about to share with you hits you like a gut punch, send this to a friend. They deserve to know. Before we dive into the cold, hard facts, let me tell you about a game that I played last weekend. My friends and I got together for Monopoly, and if you ever played a serious game of Monopoly, you know it reveals people's true investment personalities. Simon, he's the wild card. He goes all in on risky properties, mortgages, everything he owns for a shot at Boardwalk, and either crashes spectacularly or dominates the board. There's no in between with Simon. Gilbert, well, he never stops buying. Doesn't matter if it's Mediterranean Avenue or Park Place. If the bank owns it, he wants it. His strategy is simple. Own everything, build everywhere, and overwhelm the competition. Then there's Ocean. He sits back, collects his $200 when passing go, but he rarely pulls the trigger on properties. He's got his massive stack of cash, and he misses opportunity after opportunity because he's waiting for the perfect moment. And that perfect moment never comes. And finally, let's talk about Jojo. Well, he's calculating, he's patient, and he's watching everyone's moves. He'll let other players fight over the orange properties while he quietly secures utilities and the railroads. By mid-game, you suddenly realize he's built an empire right under your nose. Here's why I'm telling you this story. Right now, the economy is like the Monopoly board in the late stages of the game. The Federal Reserve is the banker, desperately trying to maintain order as the game gets more and more chaotic. Wall Street, that's Simon and Gilbert combined, aggressively buying properties, or in this case, stocks, creating an illusion of prosperity. Most Americans are like Ocean, sitting on the sidelines, watching their savings earn nothing while inflation eats away at their purchasing power. But you need to be Jojo, strategic, informed, and ready to make your move when others aren't paying attention. Because here's the truth, just like in Monopoly, the game looks different depending on your position. If you're winning, everything seems great. If you're losing, you know the board is rigged. Today, I'm going to show you what the board really looks like, not what the banker wants you to see. Let's start with the biggest illusion of all, the stock market. Turn on CNBC or open the Wall Street Journal and you'll see headlines celebrating record highs in the S&P 500. It looks fantastic on paper. The economy must be booming, right? Wrong. What they're not telling you is that the entire market is being propped up by just 7 companies. Apple, Microsoft, Google, Amazon, Nvidia, Meta, which is Facebook, and Tesla. They've been dubbed the Magnificent Seven, but there's nothing magnificent about a market that depends on so few companies for its health. Let me show you the numbers. In 2023, the S&P gained approximately 24%. Impressive, right? But if you remove those 7 stocks, the S&P would have gained only about 6%. That's a massive 18% difference. Even more concerning, at certain points, if you remove those 7 stocks, the market would actually be down. This isn't an academic observation. It's a warning sign. When 1.4% of companies in an index are responsible for 75% of its gains, that's not a healthy market. That's a market on stilts, and it only takes one of those legs to break before the whole structure comes crashing down. Consider this. In the late 1990s, the market was similarly top-heavy with tech stocks. When they crashed, they didn't just take down the NASDAQ, they dragged down the entire economy into a recession. But why is this happening? Simple. Institutional investors are piling into those 7 stocks because they're viewed as safe in an uncertain economy. They're using these companies as a substitute for bonds, creating an artificial bubble. The problem is that these companies are not immune to economic gravity. Apple faces slowing iPhone sales in China. Tesla is dealing with increased competition and margin compression. Meta is spending billions on metaverse that they may never pay off. If just 2 or 3 of these companies stumble, we won't see a gentle market correction. We'll see a violent repricing that could wipe out trillions in market value overnight. And that's not speculation, it's mathematics. When markets become disconcentrated, they become fragile, and fragile things, they break. Now let's talk about what might be the biggest economic lie of all, the job market. Month after month, the Bureau of Labor Statistics, or BLS, releases job reports that get splashed across the headlines. Economy adds 300,000 jobs. Unemployment remains at historic lows. But what happens when those numbers turn out to become complete fiction? Let me walk you through one of the most shocking data revisions in economic history. In July of 2024, the BLS reported strong job growth. Markets rallied. The Fed continues its rate hikes, and everyone celebrated this resilient economy. Fast forward to later that month to the annual benchmark revisions, and suddenly 812,000 jobs, almost a million, simply disappeared from the data. They never existed. The BLS had overestimated job growth by nearly 30%. Think that's an anomaly? Well, in December of 2023, another 619,000 jobs just vanished into thin air. And in February of this year, ADP revised away another 219,000 private sector jobs in one report. This isn't just bad accounting, it's a fundamental misrepresentation of economic reality. Here's why this matters. The Federal Reserve uses these job numbers to make decisions about interest rates. They've been hiking rates aggressively based on what they thought was a red-hot job market. But that job market was largely a statistical mirage. They thought unemployment was historically low, but the reality is far more concerning. The labor force participation rate, the percentage of actual working-age Americans in the workforce, remains below pre-pandemic levels. Millions of workers have simply vanished from the labor force. And the jobs that are being created, well, they're increasingly part-time positions or second jobs that people are taking to make ends meet. When one person takes 3 part-time jobs to survive, that counts as 3 jobs in the statistics, even though it represents one struggling worker. The truth is, the job market is far weaker than they want you to believe. And when you combine this with the next crisis I'm about to explain, you'll see why we're standing on the edge of an economic cliff. Now, this one might make you angry. While everyone's been distracted by inflation and interest rates, a massive problem has been building in the housing market, one that's been deliberately kept under wraps. And I'm talking about what could become the biggest foreclosure crisis since 2008. During the COVID pandemic, the government implemented foreclosure moratoriums to prevent a housing collapse. That made sense as an emergency measure. But what most people don't realize is that even after those official moratoriums ended, well, the Biden administration quietly continued policies that artificially suppressed foreclosures. And this came out in the Wall Street Journal just a couple days ago, and here's what they did. First, they directed government agencies like the FHA, the VA, and the USDA to create extremely generous loan modification programs. Borrowers who were seriously delinquent, we're talking 12 plus months without payments, were offered terms that no private lender or bank would approve. Second, they provided financial incentives to loan servicers to keep non-performing loans on their books rather than foreclosing, essentially paying them to look the other way. Third, they pressured Fannie Mae and Freddie Mac to continue purchasing loans that would normally be considered toxic assets, keeping the mortgage market artificially liquid. The result? Well, a massive backlog of homes that should be in foreclosure, but aren't. Let me give you some numbers. At the end of 2023, approximately 1.8% of all FHA loans were in serious delinquency, meaning 90 plus days past due. That's roughly 143,000 homes that would normally be headed to foreclosure. But the actual foreclosure rate? Just 0.7%. The gap between these numbers represents tens of thousands of homes that should be in foreclosure process but have been artificially kept out of it. Why does this matter to you? Because when these homes eventually do hit the market, and they will, they'll create downward pressure on home prices across the board. It's basic supply and demand. A sudden increase in distressed properties means more inventory, which means lower prices. And if this happens at the same time as an economic downturn, we could see a housing correction that makes 2008 look mild by comparison, especially in lower income areas where FHA loans are predominant. The government knows this, the Fed knows this, Wall Street knows this, but they don't want you to know, because an informed public might make different buying decisions about selling or refinancing their homes. Now, if what I've shared so far hasn't convinced you that we're heading for troubled economic waters, let me introduce you to something most people have never heard of, the Sahm Rule, spelled S-A-H-M, created by economist Claudia Sahm. This rule states that when the 3-month average unemployment rate rises 0.5 percentage points or more above its low from the previous 12 months, that economy has either entered into a recession or will do so very soon. It's one of the most reliable recession indicators ever developed, and guess what? It triggered. The unemployment rate, which bottomed at 3.4% in April of 2023, rose to 3.9% by October, a half percentage point increase. According to the Sahm Rule, this means a recession is either already here or imminent. But that's not the only warning sign flashing red. Manufacturing data, as measured by the ISM Manufacturing Index, has been in contraction territory, or below 50%, for 15 consecutive months as of early 2024, the longest stretch since the Great Recession. Corporate bankruptcies increased by 30% in 2023 when compared to 2022, with particularly sharp increases in retail, healthcare, and commercial real estate. The leading economic index, which combines 10 forward-looking economic indicators, has declined for 21 straight months, a streak that has never occurred outside of a recession in its 60-year history. And perhaps most tellingly, the yield curve has been inverted for over a year, one of the longest inversions in modern economic history. Every recession in the last 50 years has been preceded by an inverted yield curve. Yet somehow, mainstream financial media continues to push the narrative of a soft landing. The idea that we'll magically avoid a recession despite every historical precedent suggesting otherwise. Why? Because acknowledging the reality would force a painful repricing of assets across the board, something that would hurt the financial institutions that own those media companies. While all these economic warning signs have been flashing, Americans have been going deeper and deeper into debt just to maintain their standard of living. The numbers are staggering. Credit card debt has reached a record $1.13 trillion, with the average interest rate now above 24%, the highest in history. Auto loan delinquencies have risen for 5 consecutive quarters, with subprime auto loans now defaulting at rates approaching those seen during the 2008 financial crisis. Personal savings rates have plummeted to just 3.9%, less than half the historical average and far below what people need for financial security. Meanwhile, inflation has outpaced wage growth for much of the past 3 years, meaning the average American is effectively taking a pay cut, even as costs for essentials like food, housing, and healthcare continue to rise. This is not sustainable. The American consumer, who drives roughly 70% of our economy, is running on fumes. And when consumers can no longer spend, the entire economic house of cards collapses. Retail sales fall. Companies cut back, layoffs increase, and the negative feedback loop, well, it accelerates. We're already seeing the early signs of this consumer pullback. Retail giants like Walmart, Target, and Macy's have reported weakening sales and increasing pressure on margins. Restaurant chains are seeing fewer and fewer customers and smaller check sizes. These aren't just anecdotes, they're canaries in the economic coal mine. So given everything I've just outlined, a stock market illusion, the job market lies, the hidden foreclosure crisis, the recession indicators, and the debt bubble, what should you do about it? Particularly if you're considering buying a home or refinancing your current mortgage. Here's where things get counterintuitive. This brewing economic storm could actually create the biggest buying opportunity in real estate we've seen in a decade. When the stock market crashes and recession fears mount, the Federal Reserve will do what it always does: panic and slash interest rates. The best time to buy a home isn't when mortgage rates are at their lowest. It's right before they drop. Because when rates fall, demand is going to surge through the roof and home prices will rise. Smart buyers get in now when others are fearful, and then refinance later when rates inevitably come down. Think about it. If you buy a home today at 6.5% interest, but prices are relatively soft due to reduced demand, you can always refinance that rate later. But if you wait for rates to drop to 4 or 5.5%, you'll be competing with every other buyer who is sitting on the sidelines, driving prices up, and up. Remember the Monopoly analogy? This is your JoJo moment, the strategic player who sees opportunity when others are panicking. So here we are, the economic truth that no one wants to tell you. The stock market is being propped up by just 7 companies. The job numbers we've been celebrating were largely fabricated. A foreclosure crisis is building behind artificially low numbers. Every major recession indicator is flashing red, and American consumers, well, they're drowning in unsustainable debt. But knowledge is power. Now that you understand the actual state of the economy, you can position yourself accordingly. Be JoJo, not Ocean. make strategic moves, while others are paralyzed by mainstream narratives. If you know someone who needs to hear this, someone who's making financial decisions based on what they're hearing in the mainstream media, send this to them right now. Literally pause this video and share it. They deserve to know what's really going on. Because when it comes to your financial future, the truth isn't just important, it's everything.